Right now, there are changes happening inside Social Security that could directly affect your monthly check. Most of these changes will never make the evening news or show up in your mailbox. I have spent over 30 years helping seniors protect every dollar they have earned. Today, I am going to walk you through what is actually changing in 2026 and what you must do about it. If you are collecting Social Security or planning to start soon, this video is specifically for you. There are adjustments being made behind the scenes that most people will not discover until it is too late. Some of these changes could cost you hundreds of dollars over the next 12 months. Others could actually put more money in your pocket if you know where to look. I am not here to scare you or sell you anything today. What I am here to do is give you the same information I gave my private clients for decades. By the end of this video, you will know exactly what is changing and how to respond. There is one hidden rule near the end that most seniors have never even heard of. Let me start with the big picture so everything else makes sense. The Social Security Administration announced the 2026 cost of living adjustment at approximately 2.3%. According to SSA.gov, the average retired worker benefit in 2025 was about $1,976 per month. That 2.3% increase translates to roughly $45 more per month for the average recipient. Now, 2.3% might sound reasonable on paper, but here is the problem. Inflation for the items seniors actually buy has been running higher than the official CPI-W number used to calculate COLA. Groceries, home insurance, and medical costs have been climbing at rates well above 2.3%. So your raise is technically a raise, but your purchasing power may actually be shrinking. The Social Security Trust Fund situation adds another layer of concern for anyone paying attention. The latest trustees report projects the combined OASI and DI trust funds could face depletion around 2035. That does not mean benefits disappear entirely, but it could mean a reduction to roughly 83 cents on the dollar. Understanding this timeline helps you plan rather than panic about your future income. Medicare Part B premiums also play a direct role in what you actually take home. The standard Part B premium for 2025 was $185 per month, according to CMS.gov. Early projections suggest the 2026 premium could increase to around $190 or higher. When your Part B premium goes up, it gets deducted directly from your Social Security check before you ever see it. Let me put these numbers together so you can see the real impact on your wallet. If your COLA gives you an extra $45 per month, but Part B costs you an extra $5 to $10, your net gain drops. Then add higher prescription drug costs, increased Medicare Advantage premiums, and rising grocery bills. The actual increase you feel in your daily life could be as low as $15 to $20 per month. Now let me take you deeper into the first major change you need to understand for 2026. The Social Security earnings test is something that trips up thousands of working seniors every single year. If you are under your full retirement age and still working, there is a limit on how much you can earn. For 2025, that limit was $22,320 per year according to SSA.gov, and it adjusts slightly each year. Here is how the earnings test actually works against you if you are not careful. For every $2 you earn above the annual limit, Social Security withholds $1 from your benefits. So if you earned $30,000 while collecting early benefits, that is $7,680 over the 2025 limit. Social Security would withhold $3,840 from your checks that year, which is roughly $320 per month gone. The good news is that the earnings test limit typically goes up each year with the National Average Wage Index. For 2026, estimates suggest the limit could rise to approximately $23,000 or slightly above. That small increase means you can earn a little more without triggering the withholding penalty. But you have to know the exact number and track your earnings carefully throughout the year. There is a special rule for the year you reach your full retirement age that many people miss entirely. In that specific year, the limit jumps significantly to around $59,520 for 2025 numbers. The withholding rate also drops to $1 for every $3 earned above the higher limit. Once you actually reach your full retirement age month, the earnings test disappears completely. What most people do not realize is that withheld benefits are not actually lost forever. Once you reach full retirement age, Social Security recalculates your benefit to account for months of withholding. Your monthly payment gets adjusted upward to give back those withheld amounts over time. But this recalculation happens automatically, and many seniors never even notice the small increase. Let me give you a real-world example so this becomes perfectly clear for your situation. Imagine you are 63 years old and collecting $1,500 per month in Social Security benefits. You also work part-time and earn $28,000 per year from that job. Using the 2025 limit, you would be $5,680 over, resulting in $2,840 withheld from your annual benefits. That $2,840 withholding means roughly $237 per month disappearing from your Social Security check. For many seniors living on a tight budget, that is the difference between comfortable and struggling. The solution is either to reduce your earnings to stay under the limit or to understand the temporary nature of the withholding. Either way, you need to plan for this before it catches you by surprise. Another critical change involves the maximum taxable earnings cap that funds Social Security through payroll taxes. For 2025, the cap was set at $176,100, according to SSA.gov data. The 2026 cap is projected to increase to approximately $180,000 or higher based on wage growth trends. While this primarily affects higher earners, it influences the overall health of the system that pays your benefits. If you or your spouse still has significant wage income, this cap determines how much you pay into the system. Every dollar earned above the cap is not subject to the 6.2% Social Security payroll tax. For self-employed individuals, the combined rate is 12.4%, so crossing that threshold makes a noticeable difference. Understanding where you fall relative to the cap helps you plan your tax obligations for 2026. The maximum Social Security benefit for someone retiring at full retirement age in 2025 was $3,822 per month. For 2026, that maximum is expected to increase to approximately $3,900 or slightly more per month. To qualify for the maximum, you would need 35 years of high earnings at or above the taxable cap. Very few people actually receive the maximum, but knowing it helps you understand where your benefit falls on the spectrum. Stay with me, because what I am about to show you will surprise you. The next section covers a mistake that costs American seniors billions of dollars collectively every single year. It involves the timing of when you start your Social Security benefits and how that decision echoes for decades. Getting this wrong by even 1 year can mean tens of thousands of dollars left on the table. The second major insight involves the difference between claiming at 62, full retirement age, and age 70. If your full retirement age is 67 and your full benefit would be $2,000 per month, claiming early changes everything. At age 62, your benefit gets reduced by 30%, dropping that $2,000 down to just $1,400 per month. That is a $600 per month difference that stays with you for the rest of your life. On the other side, if you delay benefits past your full retirement age, you earn delayed retirement credits. Those credits add 8% per year to your benefit for each year you wait past full retirement age. By age 70, that $2,000 benefit would grow to $2,480 per month, according to SSA.gov calculations. The difference between claiming at 62 and waiting until 70 is a staggering $1,080 per month. Over a 20-year retirement, that $1,080 monthly difference adds up to $259,200 in additional lifetime benefits. Even comparing full retirement age to age 70, the $480 monthly difference equals $115,200 over 20 years. These are not theoretical numbers, but real dollars that either go into your bank account or evaporate. The decision of when to claim is probably the most important financial choice you will make in retirement. Now, I know what some of you are thinking right now about this claiming decision. You might be saying that you need the money now and cannot afford to wait until 70. That is a completely valid concern, and every situation is different based on your health and finances. But I want you to at least understand the math before you make a permanent decision. There is a break-even point where waiting to claim starts paying off compared to taking benefits early. If you delay from 62 to 67, the break-even typically occurs around age 78 to 80. If you delay from 67 to 70, the break-even is usually around age 82 to 83. Given that the average 65-year-old today can expect to live into their mid-80s, waiting often makes mathematical sense. Here is a scenario that catches many married couples completely off guard with devastating consequences. When one spouse passes away, the surviving spouse keeps only the higher of the two Social Security benefits. If both spouses claimed early, at reduced amounts, the survivor is stuck with a reduced check permanently. Planning your claiming strategy as a couple can protect the surviving spouse from a dramatic income drop. Let me walk you through a specific example of how this works for a married couple. John's full retirement age benefit is $2,200, and Mary's is $1,100 per month at age 67. If John waits until 70, his benefit grows to $2,728 per month with delayed retirement credits. If John dies first, Mary would receive $2,728 per month as a survivor benefit instead of her own $1,100. Compare that to a scenario where John claims early at 62 and receives only $1,540 per month. If John dies first in this scenario, Mary's survivor benefit would only be $1,540 per month instead of $2,728. That is a difference of $1,188 every single month for the rest of Mary's life as a widow. Over 15 years of widowhood, that decision would cost Mary $213,840 in lost survivor benefits. The taxation of Social Security benefits is another area where 2026 brings important considerations. Up to 85% of your Social Security benefits can be subject to federal income tax, depending on your income. The thresholds that trigger this taxation have never been adjusted for inflation since they were set in 1993. For individual filers, taxation begins when combined income exceeds just $25,000 per year. Combined income is calculated by adding your adjusted gross income, non-taxable interest, and half your Social Security benefits. For married couples filing jointly, the threshold is $32,000 for combined income. These thresholds are so low that millions more seniors get taxed on their benefits every single year. What was originally designed to tax only wealthy retirees now hits middle-income seniors who never expected to owe taxes on their benefits. Now here is the part most seniors never hear about. There are specific strategies and lesser-known rules within Social Security that could change your financial picture significantly. I am going to walk you through 3 scenarios that apply to different situations many of you are facing right now. Pay close attention, because one of these could apply directly to your circumstances. The first scenario involves the Social Security recomputation that happens automatically each year you continue working. If you are collecting benefits and still earning income, Social Security checks whether your current earnings are higher than any of your previous 35 years. If your current year replaces a lower earning year, your benefit gets recalculated upward automatically. This can add $20 to $50 or more per month to your check without you doing anything. Here is why this matters so much for people who had gaps in their work history. Social Security calculates your benefit based on your highest 35 years of earnings, adjusted for inflation. If you worked fewer than 35 years, zeros get averaged into your calculation and drag your benefit down. Every year you work now replaces one of those zeros and could boost your monthly check meaningfully. Let me give you specific numbers so you can see how this plays out in real life. Suppose you had 30 years of work history and 5 years of zeros in your calculation. If you earn $30,000 this year, that replaces one of those zeros in your benefit formula. Depending on your other earnings years, this single replacement could increase your monthly benefit by $30 to $60 per month. Over 20 years of retirement, that $30 to $60 monthly increase equals $7,200 to $14,400 in additional lifetime benefits. And that increase happens for each additional year you work that replaces another 0 year. Working just 3 more years could potentially add $90 to $180 per month to your permanent benefit. The recalculation happens automatically, but you should verify it on your My Social Security account at SSA.gov. The second scenario involves divorced spouse benefits that a surprising number of eligible seniors never claim. If you were married for at least 10 years and are currently unmarried, you may qualify for benefits on your ex-spouse's record. You can receive up to 50% of your ex-spouse's full retirement age benefit if it is higher than your own. Your ex-spouse does not even need to know you are claiming, and it does not reduce their benefit at all. For example, if your ex-spouse's full retirement age benefit is $2,400 per month, you could receive up to $1,200. If your own benefit based on your work record is only $800, switching to the divorced spouse benefit gives you an extra $400 per month. That is $4,800 more per year and $96,000 over a 20-year retirement period. Many eligible seniors never claim this benefit simply because they do not know it exists. To qualify for divorced spouse benefits, you must meet several specific criteria established by Social Security. You must have been married to your ex-spouse for at least 10 years continuously. You must be currently unmarried at the time you apply for the benefit. You must be at least 62 years old, and your ex-spouse must be entitled to Social Security benefits. There is one additional requirement that confuses many people about divorced spouse benefits eligibility. If your divorce happened less than 2 years ago, your ex-spouse must already be collecting Social Security benefits for you to claim. However, if you have been divorced for more than 2 years, you can claim even if your ex-spouse has not yet filed. This 2-year rule is something that even many Social Security office employees do not always communicate clearly. The third scenario involves the windfall elimination provision and the government pension offset that affect public sector retirees. If you worked for a state or local government that did not withhold Social Security taxes, your Social Security benefit may be reduced. The windfall elimination provision can reduce your benefit by up to $587 per month in 2025 numbers. Recent legislative efforts have been working to modify or eliminate these provisions, and 2026 could bring important changes. The Social Security Fairness Act was signed into law in January 2025, which repealed both the WEP and GPO provisions. This change affects approximately 2.8 million Americans who were previously penalized by these rules according to SSA.gov. If you are a retired teacher, firefighter, police officer, or other public employee, your benefits may have already been adjusted. You should check your current benefit amount on your My Social Security account to ensure the adjustment has been properly applied. For those affected by the WEP and GPO repeal, retroactive payments may also be owed to you by Social Security. The SSA has been working through a backlog of cases to recalculate benefits and issue back payments. Some beneficiaries could receive lump sum payments of several $1,000s covering the retroactive adjustment period. If you believe you are affected and have not yet seen a change, contact Social Security at 1-800-772-1213 immediately. Now let me share with you the hidden gem that most seniors have absolutely no idea exists within Social Security. There is a provision called the Social Security Benefit Restarting Option that very few people ever use. If you claimed benefits early and now regret that decision, you may have a way to essentially undo your choice. This little-known rule could add hundreds of dollars per month to your check for the rest of your life. Here is how the restart option works in two different ways depending on your timing. The first method is withdrawal of application, which is available within 12 months of your initial claim. You must repay all the benefits you and anyone on your record received during that period. Then your benefit is reset as if you never claimed, allowing you to refile later at a higher amount. The second method is called voluntary suspension and is available once you reach your full retirement age. If you claimed early and are now at full retirement age, you can ask Social Security to suspend your benefit payments. While suspended, your benefit earns delayed retirement credits of 8% per year up to age 70. You cannot erase the early claiming reduction, but you can add credits on top of your reduced benefit. Let me show you exactly how voluntary suspension could work with real dollar amounts. Suppose you claimed at 62 and receive a reduced benefit of $1,400 per month at your full retirement age of 67. If you suspend at 67 and wait until 70, you earn 3 years of delayed retirement credits totaling 24%. Your new benefit at 70 would be approximately $1,736 per month, which is $336 more every single month. Over 15 years from age 70 to 85, that $336 monthly increase equals $60,480 in additional lifetime benefits. You would give up approximately $50,400 in benefits during the 3 years of suspension from age 67 to 70. The break-even point comes at approximately age 79, after which you come out ahead financially every single month. For anyone in reasonable health who can afford to suspend benefits temporarily, this strategy deserves serious consideration. The eligibility criteria for voluntary suspension are straightforward but important to understand completely before acting. You must have already reached your full retirement age, which is 66, 67, or somewhere in between depending on your birth year. You must be currently receiving Social Security retirement benefits to request a suspension. You can request the suspension by calling Social Security at 1-800-772-1213 or visiting your local office in person. Now let me give you specific action steps that you should take within the next 30 days. First, create or log into your My Social Security account at SSA.gov to verify your current benefit amount is correct. Check that your earnings record shows all your past employment and reported income accurately. If you find any errors, report them immediately, because incorrect records directly reduce your monthly benefit. Second, review your most recent Social Security benefit statement and compare it to what you are actually receiving. If you were affected by the WEP or GPO repeal, confirm that your benefit has been adjusted upward accordingly. If you have not received an adjustment and believe you qualify, call SSA at 1-800-772-1213 1213 to inquire. Keep a written record of every call, including the date, time, and name of the representative you spoke with. Third, if you are between 62 and 70 and have not yet claimed benefits, run your numbers at SSA.gov using the benefit calculator tools. Consider your health, your spouse's situation, and your other income sources before making a claiming decision. If you are already collecting and are at full retirement age, evaluate whether voluntary suspension makes financial sense for you. Consult with a fee-only financial advisor who specializes in Social Security optimization if you need personalized guidance. So let me recap the most important takeaways from everything we covered today in this video. The 2026 COLA increase of approximately 2.3% translates to roughly $45 more per month for the average recipient. After Medicare Part B premium increases and inflation, your real purchasing power increase may be much smaller. Understanding the earnings test, claiming strategies, divorced spouse benefits, and suspension options can protect thousands of dollars in your retirement. If this information helped you today, please consider subscribing to the channel so you do not miss future updates. I have another video coming soon that covers a new Medicare rule for 2026 that could save you significant money on prescriptions. Share this video with a friend or family member who is approaching retirement or already collecting Social Security benefits. This channel is for educational purposes only and does not constitute financial or legal advice. Always verify directly with SSA.gov or Medicare.gov.